You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well today. Happy Thursday. Today, we're going to talk about investors hoping for a turnaround for a stock that is a loser in your portfolio. You look at it and then you're just asking yourself, is there any hope? Is there any ways that this business will make a turnaround? And it's kind of like counterintuitive, right? Because we have been told for several times and for forever, basically, to be patient. When you invest for the long term, buy and hold, do like Buffett, never sell, yada, yada. You get the point, right? And I even say all the time, stay invested, right? So you invest in a stock, you buy a stock, the stock goes down later on the road, and now you're facing a 30, 40, 50% loss in your portfolio. But you tell yourself, as long as I don't sell, I don't lose money. And this company will turn around and it's going to make it happen. And sometimes it does. And sometimes it doesn't. So how do you make a difference between a loser that you have to sell and get rid of it and just take your loss and move on, and another loser where you have to be patient and actually follow that buy and hold mentality? So here's my framework, and we're going to use it for 3 companies today. So Allied Properties, Algonquin, and Northland Power. So the framework, the basis is always the same. Your investment thesis, the reasons why you bought the stock in the first place, must be aligned with financial metrics. In other words, you need facts to back up your story. If you don't have a story, if you don't have reasons, if you don't have the explanation of why you bought a stock and it's not clearly articulated, this is exactly the first thing that you have to do for each of your stock, even for your winning one, because maybe one day they're going to slow down and you're going to wonder. So you need to understand why in the world I like this business model, why I think it's going to be a thriving company. It is crucial. And once you know why you like a stock, the second step is, okay, so what I believe in, the story, is it backed up by facts, or is it just backed up by the fact that I'm thinking this, or I read that somewhere, or Mike told me that he loved this company? That's not enough, right? Because you can borrow someone else's ideas, but you cannot borrow his conviction. So it's important that you know the reasons, you understand in what you invest. That is crucial. So here's the framework, and we're going to use it for those 3 companies. The first thing is to identify what made them good at one point. So what happened when the stock price was going up? So look back in the history, look back at the facts, review the quarterly earnings, put some context around it, like economic context, for example. So you need to know what made them darlings on the market. Second step is where they are now. What changed between the moment where the stock was going well and now it's going down? What is happening? What they are, and what are they doing right now? So what made them good? Where are they now? What are they doing different? And finally, how can they go back to growth? Because if you do not have an explanation, I'm not talking about numbers here, but really, if you cannot come up with a story with a happy ending, well, chances are there's probably none, or something that is hidden that you cannot see. But then again, you're going to lose your conviction. So you might as well not necessarily waste your time and energy on this one. So let's try this framework quickly with those 3 companies. First, Allied Properties. What made them good at one point was, well, they have prime location for real estate. The economy was doing well in Canada. Interest rate was low. So everything was great. Occupancy rate was good. And this is why they were doing good. And then what happened? Well, COVID happened. People started to work remotely. And now they still have prime location for their assets. But a lot of people don't want to come there. They just don't want to come to the office. So occupancy rate is going down. Interest rate is going up. And now we just heard that Moody's changed their credit rating to junk status. So they were investment grade, now they're not anymore. They used to have one of the strongest balance sheet among other REITs in Canada. It's not the case anymore. So this is where they are right now. What they have done so far to get out of trouble? They sold their data centers, which, I mean, it's a good move in a sense where they show confidence in doubling down in the real estate for office properties, but at the same time, they also sold a portion of their portfolio that was actually doing well. They pay down debts with this, which is great. But now moving forward, how they can turn around, and the key will be occupancy rate. And that means finding new tenants or hoping that their tenants can convince more people to come back to work so they can renew like all the floors they have instead of like cutting one or two floors. Because the problem right now is Allied Properties have very solid tenants, and the tenants are just saying, you know what, it's not a matter of I cannot pay the rent, it's just a matter of like the rent is empty, so I need to get out of that like quickly. So it's a high risk, high reward type of play. I still believe that there's like an opportunity here, but it's a tough one. And this is where your thought goes in and how you assess if Allied Properties can actually increase their occupancy rate or not. So now let's take a look at Northland Power, and we're going to end with the best one, Algonquin. So Northland Power, stock price surge in 2021, but when you look at the metrics, the real reason why it went well was just sector hype. So all green utilities, 2020, 2021, that was just easy money. Everybody wanted more of those. But when you look at the dividend triangle, so the revenues, the earnings, the free cash flows, it's kind of weak. It's kind of pretty weak. And I actually compared Northland Power to Brookfield Renewable a while ago, about a year ago, for my members. And that's what I was explaining. Like Northland Power is smaller, less diversified, and doesn't show any dividend increases over the past 5 years. So what's the point of selecting this one with weaker metrics and a similar story? Because the story is the same. We move forward to green energy. It's going to be great, yada, yada. Well, okay, so if you believe in that, well, might as well just pick a company with stronger metrics, right? So I didn't like Northland Power back then. I still don't like it right now. How a turnaround is possible? I mean, they were just like surfing a wave, but they were not the strongest surfer on that wave. So not sure how they can turn things around because they just benefit from a hype that was not created by them. They just happened to be in that business model where investors were craving for renewable utilities. So this one, I don't have strong conviction. Again, that's my perception. I'm not telling you what to do. I'm not giving you financial advice. You have to do your due diligence and review it. I'm just here to give you a framework to apply it to your losers. So let's end with Algonquin, which actually I got caught in this one, and my mistake was literally putting too much emphasis on the story on my investment thesis and not enough on numbers. You have to learn, right? We make mistakes as investors. You have to learn. But what made them good back then for Algonquin is they were growing aggressively. They benefited from a low interest rate. They decided to go mostly variable. So paying even like lower, which was great back then. They were making bunch of acquisition, and after that, they were greening their assets. So they were pretty much like buying a territory where the utility was there, and then they were going for wind or solar energy to get more subsidies, and it was rolling pretty well until interest rate goes up too fast, and when you're on variable, it hurts like a dog. So that's what put them into so much problems. Their balance sheet was incredibly weak because interest charges skyrocketed in no tomorrow. Management didn't see that coming. They got hurt, and now what they're doing is they're actually selling assets, and they're selling the renewable assets to go back to a regulated business model. So long story short, they are doing exactly the opposite of what made them a darling. So instead of making acquisition, they are selling, and instead of greening, they are going back to regulated utilities. I'm not saying it's bad. I mean, they don't have the choice right now because they need to strengthen that balance sheet. They need to convince the market that they are viable business, but it's going to take a long while before they turn things around because unless they can show growth, it's not going to go back in growth mode, and it's not going to see a stock price going up. And that is a major problem. So once again, very difficult to convince me that Algonquin can things turn around quickly. It may do it in like 5 to 10 years. Are you really willing to keep a dog in your portfolio for like 10 years? I don't know. I mean, it's you. I made my peace with that. I sold at the minute they cut the dividend because they failed me big time. Took my 50% loss and then I move on. That's the way I manage my stuff. It doesn't mean that you should be doing it. However, if you want more framework like this, if you want to have like more perspective on how sector works, how to select the sectors that would be good for your portfolio, and how to do a good review of your portfolio, I created the DSR Recession Proof Portfolio Workbook. So it's like 70 pages. It's going from like asset class to sector allocation to having a buy and sell process. You can find all of this in one place, and you just have to go to moosemarkets.com/workbook. So it's moosemarkets.com/workbook. You go there, you subscribe to my newsletter, and you will receive the book for free. It's a great tool. My DSR members are using it, and it's a great start if you want to review your portfolio and you don't know where to start and how to do it. It will give you a methodology. So, all right, guys, that's enough for today. Tomorrow it's going to be Business Friday, and until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.